quick overview of iSpirit, and then we'll dive straight in to the specifics around LSPs, building on the back of the last discussion we had. So iSpirit is a non-profit technology think tank, think and do tank. And most of us are volunteers. I myself volunteer with iSpirit and have been for the past 3 to 4 years. And we typically take a long-term view of problems. So our deep belief is that any societal change takes about 20 to 30 years to bring about, even if it's something as simple as segregating garbage. In other societies, this role of a long-term anchor is played by other institutions like, say, universities. This is what Carnegie Mellon did in the case of driverless autonomous cars, going back to the early 2000s when Chuck Thorpe set it up at CMU. And it's also played by other industry research labs as well. Then you'll have VCs and policymakers typically taking an 8 to 10-year view. And then the most important folks, which are really the entrepreneurs, the doers, taking a 3 to 5-year view of these problems, either as existing incumbents in the space or challengers coming in. And our belief is that all our volunteering is no greed and no glory. So iSpirit does not capture any of the economic value that's created from any of these platforms, either as iSpirit as an institution or individually, any of us as volunteers in this space. The two areas that we're really focused on from a long-term perspective are financial inclusion and health inclusion. And particularly in financial inclusion, the most important area for us is democratizing credit. So building out a set of public platforms, because our belief is that hard problems in India, like credit democratization, will only be solved by a jugalbandi of public infrastructure and then private innovation on top of it. So I'll now hand it over to Ankit to deep dive into the LSP public infrastructure that's coming up and what are the various opportunities for private innovators to build new types of credit products on top. So over to you, Ankit.
Thanks, Siddharth. So thank you everyone for sharing a bunch of queries from the last session. We went through them, and what we have tried to do is cover them in a cohesive manner in the next few slides. And we'll be taking more queries as well. And that the intent is that over the next few sessions and through other channels to bring out answers to all the queries that are being. So, last time we laid out a picture of the new credit ecosystem for Bharat. We spoke about how the lenders and the LSPs and the MSMEs are coming together, all being woven into this fabric where OCEN is acting as a digital public good. Bringing it all together for connecting these MSMEs who are credit worthy in many cases and need access to low cost of capital, but are not able to avail it in the best manner possible. And we defined who a loan service provider is. It is an entity which has direct business connect with the customers. It has a pulse of the business, is aware of the intricacies of their daily lives in terms of what are the troubles that they're going through in context of the problem that the LSP is trying to solve for them. And in doing so, it is acting as the agent of the borrower and would like to highlight that it is a clear departure from the DSA model, where in that direct sourcing agent model, the entity is working as an agent of the lender. So there's no commercial arrangement per se for the LSP with the lender, but they are acting as an agent of the borrower, the SME or the customer here, and charge them a value-added fees. And if you look at it, there is an implicit long-term contract in helping the customer succeed for the LSP. And in this endeavor, enabling their financial success is also very critical. And for that purpose, they do all of these for them. They help in educating them of the various credit offerings that they can bring out for them. They want to provide them the best interest rates possible. They want to tailor the financial products for them to ensure that their liquidity crunches and other financial issues that they're being affected by are taken care of. And in doing so, the LSP itself benefits greatly as well by having higher customer retention and so on. And what you see over here is that there is a very strong alignment of incentives for both, as they are both rowing in the same direction. And to highlight the difference between some of these things that we shared last time, we mentioned OCEN, we mentioned LSP, we mentioned SAHAY, but to reiterate, the analogy that we drew out last time was that theme is a reference implementation. It is an example app on top of UPI. And if you look at that context, it was basically one manifestation of what utilization of the UPI APIs could look like. Similarly, if you draw that same comparison, OCEN is the digital public good, and SAHAY is the reference example app, which is just one manifestation, and it is the first instance on top of these OCEN APIs to give an example of an LSP. Now, the SAHAY GST LSP was the demo that we gave in the first session, and we are going to give a peek into the SAHAY GEM LSP implementation as well later today. But that is what SAHAY is. It is one LSP implementation on top of OCEN, which is a digital public good, free digital public good for the entrepreneurs to utilize and build on top of it in collaboration with the lenders and other ecosystem players. And another important point that we would like to highlight is that in that demo that you saw, there's clear distinction from the TREDS platform, which was again something that came up again, is that that product was not an invoice discounting product. There was no buyer involvement. There was no factoring. It was a seller financing product based on GST invoice. So the recourse over there is on the seller and not on the buyer. And this is one point that we would like to reiterate and bring out again. So, the OCEN as a platform is, as you see in the as a network in the middle, is bringing these entities, the lenders, all of them together in a very clean, standardized interface and connect with the multiple possible LSP apps, where SAHAY is the first instance, and these apps are in turn having a direct business connect with their with the prospective borrowers, and as I said, they have a very good pulse of their business and are a very good connect with them, which basically helps them in turn serve them better. Now, just to repeat, these are the first set of lenders who had who are in a state of readiness with their OCEN implementation, and the multiple LSPs of varied category types will be engaging with them to create many new different LSP products, right? And to do all of this, they'll be implementing different parts of the India stack, because OCEN complements account aggregator and other modular parts of the India stack. And we would request you to give more feedback on the APIs that was published last week. We have been receiving a lot of good feedback already, and we are looking forward to bake that in and address more specific queries on the APIs in a deeper technical session next week. Now, the OCEN is designed to enable many types of LSPs, and different financial products will come on top of it. And if we were to look at a very simplistic framework to map out the different opportunities that an LSP can look at, is that if you're looking at building out a business or a consumer loan product, and the problem that you're trying to solve for them is around capital expense or the operational expense, then you can look at certain examples of like equipment purchase as a capital expense that would have to be provided for a business. For a business, again, for the operational expense, OPEX, you can do working capital loan product types. For a consumer, something like a pay later product helps them enable very quick sachetized loan product with quick access. Something similarly on the house improvement loan comes across for capital expense for the consumer. Today in this discussion, we'll be focusing more on the business product types, and we'll run you through some of the examples and the varied LSP possibilities that emerge on top of OCEN. and that has been a significant. That's been a major query, that what are different possible LSP types that can emerge on top of OCEN, and that is something that we'll be focusing on today. So I'll hand over to my colleague Nipun, who will be sharing more with us and sharing specific examples for different cash flow business loan product types.
So so hi everyone, good evening. My name is Nipun Kohli, and I am also a volunteer with Ankit and Siddharth with SPIRT, working on this OCEN and democratizing credit, work. And I think in the next 10 minutes, I'll cover a few aspects, right? To start with, what is the key difference here, between the new credit products which are possible on OCEN, and then I'm going to cover a little bit of different aspects of lending. How does LSP can bring value, right, with the OCEN, protocol. And I'll also peep into a couple of financial products as an example, just to give you some aspect of how this OCEN can be used to build those financial products. And, and I think these three areas I'm going to cover. To start with, this is actually how we see OCEN can enable the key differences, right? So traditionally what is happening in the country is that lending has been more of a lend and a forget model, right? So, as we all know, majority part of the business loans, which is what is being offered to businesses or SMEs, are used for working capital, right? And most of them are of a tenor of 1 to 3 years. And from a lender perspective, these are mostly like lend and forget, right? Basically, technically lender lend in a very big amount to these SMEs, and then he tries to collect them in small parts in EMIs, right? And, and which also means that there is no periodic data touch of a lender, right? Which is possible. Most of the financial product are built on balance sheets, right? And balance sheets are only available once in a year, right? Specifically in the businesses, and which also enable reassessment to be very difficult, and actually and traditional loan products have been taking a lot of lead time, sometime more than a weeks to assess. What is the enablement OCEN will enable is now technically a lender through the LSP will be able to lend, monitor, and collect seamlessly, and he or she will be able to lend in a smaller ticket size, monitors those loans and monitor the performance and collect, seamlessly. There is also going to be a continuous high data touch engagement, right? Because these LSPs are going to be a part of the transaction with the SME, and which will enable a high data touch, right? And also there is the biggest difference happening is now there is going to be understanding of erratic and cash flows. So LSPs will enable the lenders to understand this erratic and variable cash flows and build different financial products which can enable a real cash flow lending, right, for the businesses. And a smaller ticket line loans can be given as well. And one of the example we showed last time was that if within 5 minutes, loan is not only principally approved, but also dispersed into an SME bank account. So technically it's possible to disperse real time into the SME bank account, right? Within no time. And this is what we believe is the new normal, right? The new normal, the new India, the new MSMEs in India would not, traditionally MSMEs takes about 5 years to build in the country, because most of the capital is provided based on balance sheets. What we believe is the cash flow lending will enable the new MSMEs to be built in 18 months, right? And the way they will be built in 18 to 24 months is only because their cash flows would be available and the lenders would be able to give them more growth capital, right? Based on how they are performing and how their, cash flows are and their orders are appearing within their businesses. And that's the big key difference what we see, what OCEN will provide to the LSP ecosystem. So I think further on, actually, if you look at the 5 aspects of lending and how does LSP brings value to the 5 aspects of lending, right? Traditionally, DSAs, which is called direct sourcing agents, has been doing acquisition mostly, right? And their role has been on the acquisition side. Now, with the new OCEN framework and no OCEN protocol, the LSPs can actually take part in all the 5 important aspects of lending, right from acquisition. So they would be able to acquire the right customer because they are actually, customers are already part of them. The borrowers or the SMEs are already part of their business. So they will be able to acquire them at a right price and we be able to, which means eventually the borrower is going to be beneficiary because he's going to get the credit at the right price. They will also support in underwriting because there is a set of derived data set which they can enable to the lenders. This could be their own scoring model, their own data points, which can help the lenders to understand, underwrite the borrower better, right? And so LSP will be a crucial part in supporting and underwriting, right? The third important aspect is because OCEN will allow the LSP to work with all set of lender, right from the new age NBFCs to the largest PSU banks. So there is going to be a variety of interest rates, and because all the lenders have different risk appetite, hence they offer different ROIs. So LSP would be able to handle multiple types of ROIs for different personas of borrowers, right? And I think technically he doesn't need to do one-on-one integration because all this integration would be, because as soon as the lender is OCEN enabled and the LSP is OCEN enabled, they can actually go and talk bilaterally, right? LSP also can take part in one of the collections, and in one of my little peek in the product, financial product, I'll show how LSPs can help in collections also, right? And they can be because they're part of the cash flows in some of the businesses, they can actually help in entrapment of cash, and which can actually make the risk or underwriting much lesser. If you are able to technically entrapment the whole cash, the underwriting should actually go down by the significance, right? And that is what LSP would bring to the table. And the fifth important part is because they are part of the transaction and they are part of the cash flows, they can provide continuous monitoring, right? Continuous monitoring how the borrower has been doing, whether he's getting the right business or not, whether he is getting the same customer, repeat customers, and and he's getting paid from those customers. This all will be enabled through OCEN, right? And actually now, this is the reason why now LSP would be able to take part in the whole ecosystem, not only in the acquisition area, right? And just driving a little deeper into one of the product which I talked about, one of the things which we are going to talk in detail today is going to be procurement to pay, right? Look at a procurement to pay life cycle. A typical procurement to pay life cycle starts with the purchase order. So if I'm a seller and there is a buyer issue me a purchase order. Based on the purchase order, I actually go and procure material, right? Suppose I'm a fabricator, then I have to purchase steel, or I have to purchase other components. I go and purchase my raw material, and I need liquidity for purchasing of raw material. Then second, I need money to process the raw material into a finished goods, right? Then the third thing is, this is what the processing stage. The third stage is where I have to go and make a shipment, which means I have to take care of freight cost, packaging cost, and other elements, right? And post making a shipment, I deliver the goods. And once it gets delivered, then the buyer confirms whether the goods are as per the specification and the quantity, and then post that it releases the payment. This can take from anywhere from 90 to 135 days. And this on the whole life cycle, now there are variety of different financial products can be built. And as some of the examples I have tried to articulate on this slide, the first one could be pre-shipment with end use control. Now here, what happens is the lender goes and say, I will offer you credit, maybe 70% of the order value, because you are a recurring supplier to this buyer. You have been supplying, recurringly, and you have been getting paid, and there is a good amount of quality. Your on time in full has been great. And hence I will provide you, as soon as you get a PO, I'll provide you liquidity to purchase raw material. By the way, but I will not give you money directly. I will give money to your supplier technically, because that will make sure that you will buy the raw material and you will be able to, convert into a processing good or a finished product and go and sell. So the first product could be pre-shipment with end use control, right? The second variation of the product could be pre-shipment with partial end use control. So here, instead of not giving money to procure the raw material, but the guy, the lender is going to offer him liquidity to actually go and process the raw material, right? And basically maybe for salaries, maybe for running the factory, right? And so on and so forth. The third could be, once he's manufactured and the goods are being manufactured and he's ready to ship the goods, right? And he's ready to make a dispatch, right? And he has cut an GST and invoice, and the invoice, is available. Actually, the lender may offer him a pre-shipment with open and end use, for an open end use, right? Could be a third financial product. The fourth financial product could actually be after he has made the shipment, which means alongside the GST and invoice, there is an e-way bill available. There's a delivery which is being made, or a lorry receipt, or a proof of delivery being available, which becomes a proof that he has made a shipment, and the shipment is being shipped from him, right? And the fifth financial product could be post-shipment, post-delivery, right? Where the delivery is also being made and the delivery has been acknowledged by the buyer, correct? And the sixth financial product could be once the buyer has also confirmed the delivery and confirmed the goods. So if you notice that in the procure to pay credit product, there could be 6 different variety of products. But in all these cases, the lender has to make sure that there is no double financing and there is also not excess of credit being flown in. And hence this whole OCEN APIs will enable all that with the other public goods, other digital public goods, ensuring that there is no double financing happening, and some of the example on the right side, if you notice, is GEM SAHAY, which is I'm going to talk in a while. We'll talk about right from PO, is a purchase order being released. How does liquidity can be provided for, fulfilling the purchase order. The last week we talked about SAHAY GST product, which was a equivalent of a post shipment, where after the seller has created an invoice for the buyer and the invoice is available in the GSTN, based on the invoice on the GSTN, the credit, he gets a credit. That's mostly a post shipment or a post shipment, post delivery product. Now I'll just go deep into one of the product which is being conceptualized by the GEMS leadership. GEM, as we know, is the government e-marketplace which facilitate government's purchases from different suppliers, right? And GEMS have been operational for many years. Is one of the great successful project in the government of India. GEM leadership has actually conceptualized a product where a SAHAY version could be helpful for enabling cash flows to the supplier supplying on GEMS. And this is the product which been conceptualized by the GEMS leadership team, right from the CEO, CFO, sir, and other dignitaries. I'll just go in a little detail out how does the GEMS SAHAY product is being conceptualized. Very soon this will be live for the supplier supplying on GEMS. In GEMS, a supplier supplies for a government order. So the way it works is technically, first the government department, let's take an example, Airport Authority of India places an order for 10 laptops. This laptop order demand is actually listed on the GEMS portal. Multiple suppliers bids on this for this particular order, post registering them on GEMS platform. Once they actually bid for an order, the buyer, which is Airport Authority of India, selects a specific supplier. And he says, I will get this supply from Nipun Kohli as an example. Once the order is being accepted by the buyer, at that point of time, a seller can select a GEMS SAHAY option on GEMS portal. So on the GEMS portal, he can give a consent that I want to opt credit against this accepted order from SAHAY GEMS platform. And once he does that, he will be asked to go and download this GEMS SAHAY app. And on the GEMS SAHAY app, through the GSTN, will be asked to link his account, link his GEM account onto SAHAY. Once this account is being linked through the GSTN, all the approved invoices by different buyers would be available on the platform. Alongside the approved invoices, approved orders, also the invoices which he has already supplied, and those invoices have been counter accepted by the buyer, would be also available. So there are two opportunities on this product. One is an order stage where there is an order which is being counter accepted by the buyer, and buyer is saying in next 60 days, hey supplier, supply me these 10 laptops. And the second opportunity here is there is an invoice which is, or there was an earlier order for which I have already supplied an invoice and the invoice is already accepted. For both these opportunities, the seller would be able to ask for a credit. So in example one, there is a 1,50,000 rupees order and the seller can get up to 70% of the order value as a credit from multiple lenders. And this order is to be delivered in next 90 days. And then it gets paid in 45 days from there on. So technically this particular credit product will be for 130 days. And in the second example, which is for rupees 32,205, the supplier has already delivered the goods. The goods have been accepted. And in this case, he can get financing up to 95% of the invoice from the seller because the invoice has already been accepted. And in next 45 days, he anticipate a payment from the buyer. So on both these opportunities, the borrower could ask for financing offers from multiple different lenders, and lenders can give him an option at what interest rate they are ready to offer the credit, right? So in this example, as you've noticed, we are just showing this as an example that this particular seller has got offer from 3 banks, ICICI, SBI, and IDFC. He is already an existing customer of ICICI and State Bank of India. That's why it shows that KYC has already been ticked, which means he's an ETB existing to bank. And in the third bank example, this is only an example, he is not a KYC customer. So that information is also shown. It's going to be in the borrower's interest, what particular offer he would like to take. So in this case, if suppose he wants to go with ICICI offer, he can click the ICICI offer, sign up a facility agreement, which is again online, completely digital, verify his account, verify the loan agreement through an OTP, right? And once he has done this, he has to also set up his repayment. And the way the GEM repayment has been structured is that if the seller selects a SAHAY GEM product, they need to go and update a new bank account into GEMS. And this new bank account will be offered by GEMS SAHAY system. And this new bank account, once it is updated by the seller on the GEMS platform, hereon every single proceeds for this particular invoice or any other invoice would come into this account. And basically on this account, the collection agent will actually look at where does he need to route the money. If there is an outstanding invoice, if there is an outstanding loan, then the money will be going to the lender. Otherwise, the money will directly go to the seller. So it will act as a pass-through mechanism, but it will work into a cash entrapment process. Because it's a cash entrapment process, the lender would be able to give competitive rates and a better comfortable rates and better comfortable experience to the borrower. And eventually on a single click, he can get the loan dispersed, right? This is about the GEMS SAHAY product. Further on, here is another example where an LSP could actually create a financial product. In the second example, we are going to talk about today, where there is a shipper who actually uses a logistic company, a transporter, to supply his goods from his factory to his warehouses. He's a factory in, say, example, Haridwar, and he has to supply this good to Bangalore or to Mumbai. He uses a logistic company, places an order with a logistic company. Technically, a logistic company goes into a market and find out who is the truck owner, who is ready to take this order based on the availability of trucks, right? And once he has accepted the truck owner, right, which is going to pick up an order, e-way bill information and the transportation order through the same OCEN and LSP bridge implementation done by the logistic company can be sent to multiple lenders, right? And lender here will again give an option of who they want, whether they want to offer a credit against this particular freight order or not. If they want to offer a credit, the borrower here will be truck owner. The truck owner will accept the terms and condition through the LSP app. The lender again will actually go and release money, and the money could be you release for an end use control. So in this example, as I mentioned, in step number 4, the 80% of the amount is being used for an end use control. And the control could be only for fuel card and a FASTag, right? Which is what is the expense on the route, right? And that money, because the lender is very comfortable that he knows this money is going to be end use for only a fuel and a FASTag, he's comfortable releasing the money. And on the 60th day or 30th day, based on the credit term, when the shipper releases the money, it goes into again an account which is controlled by a logistic company, and logistic company which runs an LSP app. It will find out what is an outstanding with the lender, release the outstanding to the lender, and the remaining amount will go to the truck owner. So by this, a product could be very well built for thrift financing, which is where basically the working capital is provided to a trucker who doesn't have anything to hypothecate, right? Because his truck is already hypothecated against an EMI, right? So that's a second financial product which could be built using the OCEN and the LSP, where the LSP implementation is done by a logistic company. Similarly, there are a variety of other LSP products could be built, right? And some of the examples we have listed down here, right? And it could be a company which actually handle taxes or legal filings for SMEs, right? The company which files GST returns or helps them to file a GST returns, or provide them a technology product to provide them a GST return, because they have a they can also implement an LSP bridge implementation to provide credit to the SMEs. The other example is, which is the hot topic in the fintech space, is the neobanks, which actually goes and which could be another opportunity to build an LSP implementation. The third one could be Kirana Tech, right? These are the again the accounting systems and the ordering systems which has been built to enable ordering from Kirana segment. Those could be an implementation of a Kirana Tech LSP implementation, and they could actually offer them credit for their orders purchases from their dealers, distributors, or the brands, right? The another implementation which I talked about today is procurement to pay. Similarly, there could be an order to ship life cycle, which could be another LSP implementation. Then other example could be agri-tech, right? In agri-tech, because if I'm a farmer or I need to, buy a tractor, and basically here what happens is there is an aggregator who's going to procure farm products from me, and he could offer me an LSP implementation, and he could offer me an equipment financing, right? Or he could offer me a financing for seeds, or any of ingredients, would be pesticides, and so on and so forth. Similarly, a health in the health case or in the wellness case, there could be an equipment finance. Somebody could buy an MRI machine, and that could be financed against the cash flows which the machine will generate in next few months, right? And these are some of the examples of many different LSPs which are possible now with the OCEN framework. With this, I will now hand it over to Praveen, right, my colleague, and which will take over from the next slides, right? Praveen?
I just want to start off with a quick introduction. I'm Praveen, and I have been a volunteer with iSPIRT for a couple of years. And at iSPIRT, I was spearheading the whole idea of cash flow based lending. And today I'm back to being an entrepreneur once again. But I'm happy to be here this evening to talk about different types of products, different types of what kind of revenues are available for people who are trying to address the whole issue of SME credit gap in the country. Like the slide says, only 11% of MSMEs have access to credit from formal economy, and the demand is anywhere between $330 billion to $1 trillion. It's a massive opportunity when you look at it, and our banking system today, has been trying to address this opportunity, but I think multiple reasons, cost structures, multiple reasons have not, multiple things have not come together to help address this big opportunity which we have in India. So I think I also want to delve into one of the points which Nipun touched upon. He said, building a small MSME is a 5-year game, but now it can reduce to 18 to 24-month game. The biggest differentiator here, biggest takeaway from that point, which Nipun made, is that today in his talk, Nipun spoke about balance sheet based lending. But if you look at how that time to build an MSME can get reduced from 5 years to 24 months. The biggest factor here is GST. GST gives you a month-on-month, what I can say, month-on-month statement of what the sales are, what the purchases are for that particular MSME. You will know the frequency, the velocity, and value of transactions that are happening on the GST network, and that data is very, very powerful to build new products and also to fund small MSMEs who are having a GST number and who are actually transacting and doing business with bigger buyers and so on and so forth. So that is what I want to get out of the way first, and then I want to move on to the next slide. Again, building new credit products, I think is something which is where the trick lies. in the erstwhile world, if you looked at building products a couple of decades back or one decade back, the cost of assembling the product or manufacturing the product and then distributing the product was very, very, very high. Today, with thanks to the new digital stack, we have the India stack and the OCEN stack, which we have. The cost of assembling the product and then distributing it through LSPs, who already have a huge distribution network, becomes very, very cost effective. In some of the meetings and in some of the interactions, we've already told about how the cost of KYC has reduced, the cost of signing the documents has reduced. Now today, the cost of even integrating with LSPs and working with LSPs closely and assembling new products in partnership with LSPs also has truly been democratized because of this OCEN framework. And I think if you're really if you're a bank or an NBFC or even a fintech, and if you're keen on building new products, I think we should look at OCEN very, very seriously and then start building new products. So what are these products? Because today when you look at MSMEs in the country, I think between GEM and the GST, we have around 1.4 million odd MSMEs, and this is a very, very, very good attractive target base for anybody who is building products. But these MSMEs come in different sizes and shapes. If you look at it, some of them are proprietorship companies, some of them are partnership companies, some of them are private limited and public limited companies. Their turnovers are different. Their annual, what I can say, turnovers are different. They are from different industries, different categories of products they manufacture or services they provide. So the one size that fits all kind of a methodology doesn't fit. And also we also think that the innovation on the product development side has not happened in the last couple of decades or so, and that is one of the reasons why we don't see many people availing loans and loans and credit products from the formal economy. Again, there is this debate about it takes 15 days for us to get a loan from a bank or NBFC. The other debate is from a local money lender, it's almost instant. But with LSPs, we are at a unique position where we can provide these loans almost instantly. LSPs and OCENs, we can provide these loans almost instantly. Now, being an LSP comes with a responsibility because it's not like you offer the same cash credit OD product or you offer the same invoice discounting product which a bank is offering. LSPs know the customers better than anybody else, and depending on the customers, what I can say, customers' cash flows, customers' earnings, and so on and so forth, the LSP should be able to assemble a new product, take it to a bank or an BFC, and do a partnership with them, and then offer this product to the entire base. That is the philosophy behind assembling a new product and taking it to the captive customer base, which LSPs already have. What are the type of products? So in our what I can say thinking, there are 4 different types of products. Say for example, type 1 is you don't know when you're lending, you don't know what the end use is, and you don't even have visibility into this person's cash flows, or you've not even trapped the incoming cash flows of this person. Example is a typical personal loan. Somebody applies for a personal loan, he has a job, the bank gives a personal loan to him. Only on the 30th of the month, when the NASH gets rejected or eNASH gets rejected, will the lender know that boss, my borrower has defaulted. Now these are the worst type of products, and these are the products that are responsible for a lot of defaults and so on and so forth. Then we have the type 2 products, like for example, a consumer durable loan or a house loan, where you have restricted the end use, but you don't have any visibility into the cash flows of this particular person. So you have a car loan, for example, you've given the car loan to this person, you directly pay to the dealer, but you don't even know whether I as a borrower have the wherewithal to pay the next EMI or not after the loan is given in 6 months hence. So there is no continuous monitoring, which Nipun spoke about in this type of loans. Now, the third one is we don't know. I mean, I think there is some there's a mistake in type 3. We don't know what the end use is, but we have visibility into incoming cash flows. So this typically an example could be you tie up with a Swiggy or you tie up with a Zomato, and you give loans to a Swiggy delivery boy, or you give loans to a Zomato hotelier. Now these are the type of loans, or Make My Trip hotelier. Now this is the type of loans where you're not controlling the end use, but you have visibility into incoming cash flows. Now this is also a problem for us because we don't know whether the money has been used to buy something for the business, or has it been put to good use or not. So my apologies, there is some because the error there, but that is what type 3 loans are. Type 4 loans are the most safest. It's as good as secure loans, I would say, because you're actually paying for the end use, and you also have visibility into cash, and then recover your weekly EMIs or daily EMIs or whatever that is. So these are the 4 types are the kind of products that should be there in the market, and LSPs should always focus on building these type 4 loans, and also be the agent of the borrower and help the borrower get loans at optimal interest rates, sustainable interest rates, I would say, and also help the lender recover those monies and build a good partnership. That's our take on the new credit products, and these products could be used for multiple end users. So if I even take example of a Zomato or a Swiggy delivery boy or a Make My Trip, in Make My Trip kind of an example, you could always give a hotelier money to pay their bills, or money to pay the electricity bill, money to run their payroll, or whatever that is. So these are the kind of loan products that will really change the game. Change the game as we know it. And yeah, this is again, talking more about type 4 loan products. They should be digitally disbursed. Again, the moment you add wet signatures, the moment you add physical signings and so on and so forth, the cost will escalate, and you can't really do small sachetized products. And the key is to identify the end use of the loan product, and also pay for the end use, so that we know very well that the money is being used for business purposes, and it's not being used for unintended purposes. And repayment should always be enabled by locking off incoming cash flows. Again, this will to a larger extent reduce the NPA stress in the market, in the portfolio. We are not even saying that it will reduce 100% of the stress, but we can mitigate the risk of stress in the portfolio. And that is what our hypothesis is with respect to end use type 4 loans. And OCEN makes it very easy for lenders and NBFCs and fintechs also to build these credit products and mass distribute these credit products. So that is I think what I want to cover. And the bottom line here is we need new thinking with respect to new thinking and new frameworks to build new products and new financial offerings to the market. That is what I want to cover today, and hand over to Ankit.
Thanks, Praveen. So adding to what you just said, to bring these products to life, to bring this to enable cash flow based lending for the Bharat, Credol is a source of information for OCEN and cash flow based lending related aspects. And it's a collective of lending ecosystem players to drive cash flow based lending. And we wanted to share a very broad checklist for an entity to become a loan service provider today. So I'll quickly just run through these points one by one. So the first point is for any entity to engage with the published OCEN related resources. We publish the APIs, and we've been getting feedback on that already, and the business aspects related different content that we'll be publishing on the Credol website, which is credol.org. and otherwise on different channels. So I would request the interested entities to go through them and share their feedback on that and raise any queries on that. Secondly, once they have consumed that data, they've digested that, it's important for then LSP to carry out a self-assessment for the different credit products that they want to build out for their customers in collaboration with lenders. So the LSP will map the persona of their borrowers. It will map what are the different product types that they can offer for them. And we'll get into it in a deeper dive in the upcoming sessions as well. Thirdly, once the prospective LSPs have done that, we'll be sharing further details on the OCEN API sandboxes that they can tinker around with and play with. And alongside in this journey, they'll be designing the different product experiences for their customers to provide them different type of loan products. Then once they've implemented the OCEN APIs, there is a light certification that will be facilitated by a CREDOL empaneled agency. And the light certification exists to ensure a very neat and tight integration with the APIs to ensure that the experience for the borrower is homogeneous and uniform across different LSPs, and various aspects such as security related issues and so on are taken care of from the get-go. And that will essentially ensure that a delightful experience is provided to the borrowers while they consume different offerings by the LSPs through these OCEN APIs. And then subsequently, the go live will be facilitated again by CREDOL with all the different OCEN certified lenders who are coming on board. And we'll be sharing further details around it in the coming days on the CREDOL website as well, and in an upcoming session. With that, I'll hand it over to Siddharth.
So essentially, to summarize, to bring cash flow lending to life, it requires the coming together of 8 players across providers of capital, namely the lenders, different types of rating agencies like the bureaus, derived data providers, and folks that help analyze that data from an underwriting perspective, which are different underwriting modelers, different data providers itself, like account aggregators that facilitate access to GST, bank account, and other types of information. And then different repayment providers like the UPI players, and last but not the least, the technology partners that kind of lubricate the entire chain and make all the interconnects happen seamlessly. So far, we've primarily focused on cash flow lending towards MSMEs, and those are the examples that Nipun highlighted earlier today. And in the coming sessions, we will talk about how cash flow lending for consumers would also look like. So we've got a set of questions on that, and we'll take that up in the subsequent sessions. We can now open it up to questions. I was just going through what all you've submitted, and feel free to add any new questions based on the link shared here. One question that's come in, and maybe Nipun, you could help answer this, is how does this relate to TRED? So SAHAY GST, which is an early LSP implementation, which a financial product, namely invoice financing, TREDS 2 provides something similar. So how does the whole LSP framework relate to TREDS, relate to the TREDS second window concept that's been spoken about in the UK SENA MSME report? If you could if you could share some details about that, that would be super useful.
Yeah, so thanks, Siddharth. So this is a very appropriate question, that how does, and I think, so first of all, TREDS, as we know, is a factoring product, right? Out there is a outright purchase of a receivable. So if I'm a seller and I have supplied 100 rupees of goods to a buyer, the buyer has accepted my goods and accepted my invoice, and he acknowledges that he will make a payment on an X date. Now, this invoice, which is already an accepted invoice, can be traded on an exchange, which is what is the TREDS implementation of RBI, right? And it's been run by 3 companies and been scaling up very rapidly, right? And out there in trades, the invoice from the seller is bought by the lender, and the lenders, so technically there is a deed of assignation, and there is invoice is traded on the platform and is been bought by the lender, and the lender now is the buyer owes money to the lender and doesn't owe any money to the seller, right? And the recourse here is technically shifting from the seller to the buyer, right? And now buyer is responsible to make the payment to the lender. If buyer doesn't make the payment, buyer actually goes at risk. There is no recourse on the seller. Like Ankit mentioned earlier, right? And we had mentioned in one of our slides that SAHAY GST is an implementation of a seller finance. And the primary difference is in the SAHAY GST, the recourse is on seller. So from a lender perspective, even if buyer does not make a payment, or if it makes the payment, then the payment can be made for the loan. In case the buyer doesn't pay the payment, or there's any dispute or any kind of challenge, then the recourse here is only on the seller. So it's technically an unsecured loan on the seller, which he's agreeing to pay in the term which he agrees. In case buyer makes the payment, that payment can actually go and clear the bill, clear the particular lending in case of any disputes, which is going to be very, very rare, because this is where the lender will take care that it will go and measure that there is a recurring supply, the quality of the buyer, and maybe also accessing the bank statement through account aggregator and making sure that there is a payment which has been coming in. So there's going to be those kind of underwriting which will be done to ensure that this is a recurring supply and this buyer will make the payment. And once the buyer makes the payment, the repayment will be made by the seller. So the primary difference is in the SAHAY GST, the repayment is coming from the seller. In the trades, the repayment comes from the buyer. And in the SAHAY GST, the recourse is on the seller. There is no recourse on the buyer, and which also means there is no technically acceptance required of the buyer, right? Which is one of those primary requisite in the trades, and that's why it has been also listed. And I would actually urge you guys to go and read, and we can also post this as a link. There is an MSME committee report which came out in June 2019, and under the leadership of Mr. UK Sinha, and our colleague Mr. Sharad Sharma was also part of that committee. And the committee actually, one of the recommendations made by the committee was a trade second window. And the reason why trade second window was recommended, so that the seller, without having a constraint of buyer accepting an invoice, could get credit from the bank. And SAHAY GST is an implementation of a trade second window. So I think if you go through the section 8 of MSME committee report, you can go through in detail. I think the whole implementation is laid out very nicely in the MSME committee of Mr. UK Sinha.
Thanks, Nipun. And in fact, you touched upon an important point of underwriting. But before I go there, I just wanted to mention Nipun made a rather humble introduction of himself. But in his previous avatar, he was also the founder of one of India's largest supply chain finance companies, and that then got acquired. And he's got deep belief and conviction that this new model on the back of public infrastructure is going to be the new way of lending, and so he's spending his time volunteering to build out this public infra. The second question is around underwriting, and this is for you, Ankit. So where does underwriting happen? Does it happen within the domain of an LSP? Does it happen within the domain of a lender? And at the time of underwriting, you often need access to multiple sets of information. One is, of course, the contextual information from the LSP, but then you also need access to the bank account information via account aggregator, and then the previous liabilities of that borrower from the bureau. So does the LSP get access to this, or is it the lender that gets access to this?
Yeah, sure, Sid. So it is the lender that is carrying out the underwriting here. And even in the SAHAY demo that we had, SAHAY GST demo that we had given earlier, and even in this GEM implementation as well, the underwriting is done on the lender's end. The lender is the one which fetches the data from the account aggregators, the financial information of the prospective borrower to carry out underwriting. Now, the LSP as an entity is lightly certified. They are not accessing the financial information of the borrower. And in this case, they're not the FIU. So they're not the financial information user as part of the account aggregator ecosystem. So if an LSP wants access to the financial information data and wants to become an FIU, then that will be a separate sister entity of the LSP concerned entity that will do that. So LSP as an entity will solve for distribution. It will help in surfacing of the creditworthy borrowers at a very low cost of acquisition for it to be funneled to the lenders. And it will provide relevant data signals with regards to the business activity data of the borrower on the platform. And there can be different kind of scores, customer ratings, etc., that can basically help different underwriters to it. But as you had shown in that slide earlier, in this whole value chain, the underwriting modelers is a separate entity. The LSP is a separate entity, but they are all working together cohesively to bring this together. And an LSP itself can take on different, an LSP entity today can see that what is the strategic call as a business and what are different roles in that value chain that they want to play. And that is something that we're going to deep dive into the upcoming sessions as well. And that is where we are looking forward to see how the different players scan the whole playground and make a sense of that which are these different components of the value chain that they want to go after, and which are these components of the value chain that they want to tie in together to create really good product experiences for their customers.
So Siddharth, if you may allow, I may want to add a little bit, right, to Ankit. So just to add on to Ankit's point, see, RBI does, only allows a lender, to actually do underwriting, and hence lender is going to be the one which is going to make an underwriting, policy. But LSP plays a very vital role in creating these financial products with the lender, because LSP is the most closest party to the borrower. He knows what is the right personas of the borrower. In some cases, they know their own ratings, right? They are part of the cash flows, right? They also understand what frequencies, within the list of personas of the borrowers, LSP has, who has good rating, who has not so good rating. So they are a very, very vital role in actually helping lenders to choose the right borrowers and to choose the right risk. So I also believe that there is going to be a commingle between the lenders and the LSP to build these financial products. And these financial products may vary from different, LSPs. So somebody in the agri-tech space can have a very different persona of the borrower, and they may actually be able to give certain signals which lender does not even have a capacity or capability to get one. And and something which Paveen mentioned, that end use controlled, right? Some of these LSPs are in an end use control business. They know exactly if the money is being given by the lender, the money is going to be used for an end use, which is a controlled end use, and hence the lender will become very comfortable in building the financial product. The third kind of LSP, as an example, could be one which can help in cash entrapment, because they are part of the payments. They are actually part of the payments, and hence they will facilitate those payments collections or certain other services for the lender, which will ultimately make the underwriting much easier for a lender. So in very simple way, if you look at a pendulum, right, if you are able to do 100% entrapment of cash, and you are able to find out that it's a genuine transaction, your underwriting technically should be almost zero, right? So as long as the guy is fairly good, he's been intention to repay has been there, his business has been generating cash, there is no other details which are required to underwrite. So this is where vital financial products would be built by LSPs, and LSPs will be the very important part in building these multiple different financial products on their own domains, right?
So one thing
we'll
you touched upon. Sorry, go ahead, Ankit.
Yeah, I was saying, and we'll be publishing all the information with regards to these various different approaches that the LSPs can take to collaborate with lenders for different product types on the Credol website, as just mentioned, and we look forward to the engagement from the market players over there.
One last question, and Nipun, this touches upon the point you brought up of intermingling between the LSP and the lenders, right? And oftentimes the LSP taking a stance as an agent of the borrower will come up with a financial product, but lenders on the back end will be risk averse, right? And one way to assuage them as part of that journey is essentially through an FLDG construct, right? Where the LSP can essentially absorb any first loss or any initial set of defaults on that loan that's given out, and that builds comfort of the lenders and helps drive expansion towards the market, towards borrower pools that typically wouldn't have been lent to. So could you share more details about that?
Yeah, sure. So I think, and that's very fair question, right? And very appropriate question, Siddharth. And I think lenders, because, India has not been, we have never seen these kind of financial products so far. And from the lender's perspective, because they are mostly engaged with balance sheets and annual reports and P&L and profitability, right? And, and hence they have never seen, they have very limited experience of looking at cash flows, and which is where LSPs actually plays another vital role. And he says that because I understand my borrower very well, I understand my customers very well. I need to make sure that their business grows, because these are the right people. They are the right green shoots I would like to, go and provide more credit to, because I am the one who is monitoring them. I am the one which is in the game. I am being involved daily with them, right? And hence I could go and say that these guys will not, because they are producing cash and their business is been generating cash. Their balance sheet may not be good, right? They may not have put a lot of equity in the business, but they have enough orders. They have been actually getting repayments from the customer. And hence I go and say, I become technically an insurer and making sure, hey lender, you don't become uncomfortable. You go and go through your norms, but I want the right price from my customer, because I want to grow, have them grow. And here is my risk, which I will take on the table, because, I know them better than you. And which is where, the FLDG component will play a vital role. And, and I think in the few initial spaces, we will see a lot of financial products being built on the back of FLDG. Over time, I would believe the lender will cope up, and I think they will actually go and reduce the FLDG as soon as they see less risk and stuff. But I think that's here where the marry between the financial products of FLDG and, and the loan will happen. I think Praveen also touched upon this point very deeply. You notice today, unsecured loans at a very high teens number, right? And in high teens number, the business doesn't sustain, right? So technically, and that is where the LSP will come in and say, I don't want my borrower to get a high teens loans. I want him to get a low teen loans. And basically, because I am in the mix, I'm going to put the risk on the table, and, it'll make the lender comfortable. I think it's going to make lender more believe, right, to try out new financial products. Over time, this FLDG number will go down, and eventually, cost of fund will play a vital role. But I think that is going to be a very important play, right, going forward.
Sid, if I can add something here, my view is that, my view is that the LSP knows the pulse of the business of the borrower, right? And that is very, very vital today. If you look at the relationship between borrower and lender today, like Nipun mentioned, on the 30th day or on the day when the EMI has to come, when the EMI has not come, that is when the lender will wake up and put all his, what I can say, all his recollection mechanisms into play. But, in the LSP kind of an environment, what happens is, LSP will be able to provide daily reports to the lender as to how much business his borrower has done on that particular day. Based on that, at the end of if the EMI has to be paid at the end of the week, the lender will know whether the EMI for that particular week or installment for that week is coming or not, or installment for the fortnight is coming or not. If it is not coming, by what percentage is it not coming? Is it 0, or is it going to be 80% of the installment, or is it 100% of the installment. And in cases there might be people who are doing good business and they want to kind of prepay. Lender will also will also have an option to collect more monies and close the loan faster, and give a new loan to this particular gentleman because he's behaved very well. So LSPs know the pulse of the borrower better than anybody else. So that is absolutely interesting when it comes to designing and building new products. That's number one. The second thing is Nipun touched upon the FLDG, and you asked a question about FLDG. I think going forward, when LSPs and lenders are working in harmony, the whole FLDG conversation will evaporate, and I don't think there'll be any friction with respect to FLDG. These initial, initial few months or couple of years, the FLDG conversation will still persist, but in the long run, I don't think FLDG will even matter because lenders and LSPs are working in harmony, and they're working towards a common goal of making money and mitigating risks. And LSPs are the only way to go, and OCEN is a bridge for which will make that happen.
So I think Sid, if you allow, I just wanted to throw some points from my personal experience, and talk about few things what LSP should maybe consider, right, while building these financial products. So I have been a two-time MSME myself, right? I have seen myself that MSME businesses in India die because, and in my previous avatar, I was in very close contact with million plus MSMEs, right? And which were suppliers to large corporates, mid corporates, and stuff. What I've learned is that MSMEs businesses do not get they only die because of cash flows. They don't die because of profitability. Whatever happens, right, and whatever going to happen, even in the COVID scenario, the mortalities are because of cash flows, not because of profitability in the business. They have profits, but they have erratic cash flows, and sometimes they don't get paid on time, and they are not able to. And I think there are three important elements of what my learning tells me, which one LSP has to consider while building a financial products, and which I call 3 C's, right, for me, right? One is abundance of capital. So there should be growth capital available for a business, MSME business, which is growing, or for any business which is growing. And there should be abundance of capital. That should not be restricted based on balance sheets and assets and these ratios. It should be based on cash flows, right? The cash flow has been great. If he's getting more orders, if he's getting more repayments, customers are loving him, he should get disproportionate cash, right? And that is very important. The first is the capital C. The second is certainty. If I need money on Monday, 10 o'clock, I need money Monday on 10 o'clock, right? And I need to make sure that if I go and apply on Monday, 9 o'clock, I should get money by the 10 in the bank account so that I can use an end use, right? And this is very crucial. It's a certainty of capital, certainty on a specific day, specific time, because the money actually at that point of time has tremendous value for a business, right? And the third important part is the convenience. How conveniently I can get money, right? If I deserve money, how conveniently I can get money. It should not happen that I need to fill so many forms and so many paperwork. So this is what I call 3 C's are very crucial, important for one to build an LSP implementation or LSP financial product. So, and maybe it might be worth considering those while some of us will be considering building an LSP financial products here.
Thanks, Nipun. And so with that, that's a wrap on the questions. If you're interested in participating either as an LSP or as a lender or as a technology partner, please feel free to drop us an email at community@ispirit.in. The next open house discussion will essentially be focused on the technology behind OCEN. So the underlying API flows between the lender and the LSP. We'll go through that in detail. And my only request is, here's the link of the technology specification. So prior to the next session, please do go through that. And if you have any questions, feel free to post it on the link that Karthik has shared. And here are a set of general content that you can go through to get an overview of the cash flow lending system. The UK SINA MSME committee report would be the best primer. And then to understand how account aggregator works, and the flow of bank and GST information, this would be the best primer.